Today, folks, it is finally happening. Crap is hitting the fan at the worst time in the midst of earnings when these earnings are so damn good. And it all has to do with the US debt being reweighted from AAA rated quality down just slightly, making these big hedgies a little fearful. Like, let's take some of this profit. The markets ran a lot. And we're going to be talking about 4 stocks that I think are very interesting. We're going to talk about PayPal, Shopify. We're going to get into MO, some of them addicting stocks, along with Starbucks. And if that's a conversation you'd appreciate, hit that like button because we'll also talk about some of this reweighting of the US debt. But I'm sure you scrolled into your stock portfolio watch list today and you're like, whoa, this is crazy. Because when we're seeing the likes of, Microsoft, Meta drop 3% in a given day, that's tens of billions of dollars off the market cap. It pulled the S&P back, VOO, by 1.4% almost. And right when we were on the edge of all-time highs. And I still think we can get there because there's still some lower half stocks being bought up. Johnson & Johnson's, some of the consumer staples out there as people, again, just want to diversify. I think that money will naturally move into the lower half of the market. As we mentioned, financial stock sectors that are a little more undervalued, and that could potentially keep some pressure to the upside and kind of cushion this blow that we've seen today. And I still think people are going to buy up some of these dips. I think the market can only drop so much now because earnings are good. It looks like we're actually going to see a soft landing. That's me speculating. There's no guarantee about that, and I'd love to know what you think about it in the comments section below. But obviously the stocks have sunk after this historic reweighting this Wednesday, trading following the downgrade of the US debt from that highest AAA rating to a AA rating plus by Fitch. I've never heard of this before. I don't know how this news moves the market or what the actual infliction is on the global economy when the debt gets reweighted. I'm ignorant to that fact. I don't buy stocks based off those facts. But nonetheless, earnings season, meanwhile, is more than halfway through. About 82% of the S&P 500 companies have beaten expectations. Can you believe that? Almost the vast majority of stocks have just crushed what people were expecting, but analysts are dumb. They definitely underplayed where we were heading. And even if they played it a little more bullish, I still think things would have come in at expectations. But yeah, let's get into this because, again, mind-blowing stuff here. First and foremost, guys, these are the stocks. We're still in the midst of all of this. A lot of stocks coming out in the latter half. I think we have Apple next week, but I want to talk about Shopify, PayPal. They just posted. We're going to get into Starbucks and, of course, Altria Group. These are the ones that I just personally am interested in. If you have one you're interested in, let me know in the comment section below. And while you're down there, if you want to join my chat groups where we actually dive into all of these stocks, we talk about this stuff on a daily basis. You can chat with me and 60 other high net worth individuals. Just join my Patreon members, get access to some cool tools. Just a quick shout out, but you can always come here for free, right? But taking a look at PayPal, guys. PayPal. I did not buy this one because I like the Canadian banks for my financial exposure. Talked about that relentlessly, but I've always stated that I think PayPal is way more at a fair valuation here. And even on its earnings, it dropped 8% at the bottom. It's kind of returning to where it was sitting about a month ago, which isn't too crazy. But again, I think these are setting up to be further buying opportunities for you more long-minded focused investors. And I want to break down why, because PayPal stock fell on earnings beat, but margin metrics miss. They missed, but they're still up over last year. So let's just break some of the numbers down here because, again, they're not talking about the same kind of growth we're seeing in Google or Meta. Those stocks have done actually way more better than anyone was expecting. But total payment volume was up by 11%, $376 billion. That's how much payment volume is going on this platform. Net revenues of $7.3 billion. They grew 7%, 8% on foreign exchange, obviously a little bit because I don't know what the dollar's been doing, but nonetheless, 7% isn't anything crazy. But what I want to point out is how much people are using PayPal. This thing has a severe moat to its business, and you can see it in some of these little data points hidden down here. First and foremost, 54.7 payment transactions per active account on a trailing 12-month basis, which is up 12%. People that currently use PayPal are using it more and more and more, and then as new users come on, PayPal is just crushing it. They have such an incredible business here. I mean, how can you not state that when there's 376 billion in total payment volume, which grew by 11%, right? I mean, these metrics are good. And when we talk about the margins that missed, did they really miss that bad? If I can find it here, the operating margins were up 15.5%. But over last year's 11.2. So what were the analysts expecting? I mean, those are pretty good, right? This is on a GAAP basis. Net revenue, everything here looks actually pretty good. Net income was up pretty dramatically year over year as well. So again, everything that I look at a glance says, amazing, right? Look at Shopify. Now, I always kind of had a love-hate relationship because I just never bring myself to buy it, even though it's probably going to be one of Canada's largest tech companies and could potentially be the largest market cap company in Canada at some point, outpacing Royal Bank. And this one had a sputter, a little bit of a heart attack here, and then flatlined after a wicked run from October. I think the stock's up, what, like 140%, give or take. And Shopify, again, more astounding than the last quarter because not only did they beat estimates, they beat it by an astounding 31%. I mean, growing over this time last year. Let's just take a look at that. Again, absolutely incredible here. So subscription solutions, we're at 444 million versus 366 million last year. Merchant solutions at 1.25 billion, up from 929 million. I mean, these numbers are, you know, this just shows that everybody's using Shopify. Everyone's going into e-commerce. Everyone knows they want to work from home, do things online. Everyone's going to be getting online stores. This is something that just is a societal norm at this point. So their growth isn't going to slow down here. I just can't see it, right? But what they did do, gross profit was reasonably good here. We saw some good growth there, but where they got hit was on the impairment on the sale of the Shopify logistics business. Shopify in the glory days, they hired everyone they could under the sun. They're like, oh, we're going to compete with Amazon. And then they realized, hey, I think we're getting a little overzealous here. You know, the recession looks like things are slowing down. Let's do some layoffs. Hey guys, let's get rid of this logistics. That was stupid. That's costly. Let's focus on the core of our business, the software, the crazy moat of just, you know, when people think of e-commerce, they think of Shopify, and that is working to their favor. But they took that 1.6 total billion dollar loss from operations, which again wouldn't have been nearly as substantial. But so next quarter we can expect this impairment charge to be written off from, you know, this quarter, and they should start seeing again GAAP profitability. I don't know if that actually reflects into the bottom line cash flow, but this is a company, let me just point out here, total assets 9.7 billion with 1.6 billion in cash, and their total liability set at 1.3 billion. They could literally pay off all their total liabilities tomorrow, have 300 million left in cash. This company is really foundational. I still think it trades at a little bit of a premium here for talking about valuations, underlying stuff. But again, I'll leave that question up to you because sometimes these businesses are just better to cost average into the tops, the bottoms, and own for the long term than they are to speculate on the current value and if they're worth buying. But look at Starbucks. Let's get into the dividend payers. This is a favorite in the YouTube community. I know PPC Ian, I think it's one of his top stocks, and this one actually didn't do much after earnings. It did pop up a little bit, but nothing substantial. But these earnings were astounding, and let me just kind of get into this because Starbucks is, you know, one of these addictions that I'll never do. I think making coffee at home, I don't even go to Tim Hortons or like the lower end like Dunkin' Donuts if you're in the US, because coffee is a joke. Coffee's overpriced garbage. It's more of a thing where like I just went and got an oil change and I got a free coffee. Like I'm not buying this crap. It's just, that's what, if you want to be rich in retirement phase mindset, and you don't buy this stuff, but you could buy the stock, and these are the good reasons why. I mean, first and foremost, the coffee giant saw a skyrocketing 46% increase in the same store sales in China alone. The company's same store sales grew 10% overall, falling short of the estimates of 11%, who they missed by a percentage point here, guys. It seems like the company has more internal problems when it comes to unionization and stuff than they actually do like operating problems. So when this thing dips at any dip, just buy it. Just buy it. It's a long-term buy and hold kind of company. And taking a look at what's most astounding is the store count. How is this company in something you think would saturate the market by now? But I guess these young kids, they got to have that status symbol in their hand always. That their store count is at 19,630, up 10% year over year. Baby, those numbers are astounding here. Like every metric here just kind of makes me happy. I mean, operating margin, I don't know what they did here, but their operating margin jumped pretty dramatically all in all. But what's more incredible, again, you just take a look and people are saying it's not that great, is obviously the earnings side of it. But I still think Q3 consolidated net revenue up 12% to 9.2 billion isn't something to be like, ooh, that's terrible. I mean, it's growing a double-digit basis on revenue. That's better than PayPal right now. And the stock did nothing, obviously. No one really cares. But even way, they got a reward membership that reached 331.4 million, up 15% year over year. God, this is like McDonald's, right? Like these companies are just finding ways to pack in those dollars. It's the same addiction, man. Caffeine, this is my favorite addictive stock. I wouldn't even say it's a consumer discretion or a consumer staple sector. It's more of something like MO, like the tobacco sector. This is something that people are just going to forever do. It's never going to go anywhere. However, I would pick Starbucks over something like Altria Group. And I've stated this, some of you commented that I didn't like GEO Group because even though the stocks are cheap, MO's cheap, I would say GEO Group, prison stocks, they're cheap. The problem is fund managers will never buy this. The optics around tobacco, it's like the ESG environment that we're in. All these big hedgies have to follow some rules, and tobacco will never fit that. So the stock's never been able to see a massive bump. It hit its low in 2020 during the pandemic, and it's only up 30%. it's never going to give you real capital gains. It's just never going to happen. It's an entire income focused stock. And I think there's going to be an inevitable inflection point where all of a sudden the older generation that still smokes, as newcomers, younger people, they don't want to smoke. They just don't. They're going to do vapes, they're going to do the pouches, they're going to do anything other than smoking. But that's where all Altria's money comes from, and they're fixated in the US. So there's going to be an inflection point at some time where the older people start dying off and there's not enough young people to replace the smokers, and the stock is going to run into issues. It's not a long-term company to hold, in my humble opinion. If you want long term, look for things like British American Tobacco, Philip Morris, something that has more of a stake in the nuance of people's addictions, rather than this company that can only be fixated in the US, doesn't have a good global presence, and is really stuck to the traditional older, way of thinking. And you can see that the returns have not been astounding. It is purely an income oriented stock. If you need income today, there's nothing wrong with it. But again, you're going to underperform the market. And I think that's going to continue to be that way. I mean, since 2017, they haven't been able to keep up with the general market returns, but Altria did beat revenue profit expectations on demand for the nicotine pouches, as mentioned. And again, I just don't think this is anything too crazy. Taking a look at the actual numbers themselves here, net revenue came in at 0.5% higher than this time last year, and revenues net of excess taxes, is only up 1.2%. We're taking a look at those sales, like Marlboro, just to give you the exact conclusion here. Year over year, Marlboro cigarettes down 7.6%. That's where all their money comes from. Other premiums also down. People are just smoking less and less. You can't argue that. Total cigarette sales down 8.7%. If we keep losing at almost double digits, that's going to pick up quick. It's almost compounding, and that inflection point is an inevitability. Cigars, however, people still seem to like their cigars, but it's such a small segment. It's not going to lead to anything crazy. Total smokable products, again, down 8.3% year over year. These are the products that are growing, and I wouldn't state that they're growing quick enough to make up for the difference in cigarettes, because look, I mean, we're talking about such an incremental amount. 114, Copenhagen, you're talking about Skoal. These are some of those chewing tobacco, the oral products, and they overall, the total products grew by 1.7%. Got a long way to go to meet up with the total sale equivalent of the actual tobacco products, the smokable products. But again, I want to pass the question off to you. What do you guys think? I'd love to know everything so we can continue this conversation down the road.